everyone, welcome to the 24/7 JIB CIB English Medium channel. I hope you all are doing good, and if you're preparing for upcoming CIB December 26th, then remember today's session is very important because today we are going to discuss Unit 10. Now, in this Unit 10, you will be learning if you are starting any new project outside India. So, how to evaluate it? Yes, because I hope you have watched our previous session. If no, then please go and watch our first previous session, that is Unit 9, where we discussed about what is the meaning of capital investment decision. Because now in this unit you are going to learn one additional part of it, that if you are starting any business outside India, then how to calculate the benefit. Okay, chaliye. So let's start today's session, and if you haven't subscribed to our channel, do it right now. Share this session with your friends and colleagues also, so that they get the maximum benefit out of this session. Okay, so what is capital budgeting? It means estimating the financial viability of a capital investment over the life of the investment. Yes, basically, if you want to start any business, what is the output, what is the income that you are going to generate by investing? That is about capital budgeting. But in this unit, this capital investment you are going to do internationally, means across your you can say domestic boundaries. So in this international projects, when you are starting any business outside India, outside your domestic boundaries, so what are the things that you need to estimate? Yes, like you need to understand about their laws and regulation, about their, let's say, culture, about political beliefs, technology they are following, competitors. Yes, all these factors you need to first understand, and then only you can start any new business outside your domestic boundaries. And very important factor, that is your exchange rate. Yes, this exchange rate is very important for you. What is exchange rate right now? Let's see, $1 is equal to rupees 96. So this is the exchange rate. Like if you give 96 rupees, you will get $1. Yes, so that is what exchange rate. So very important when you are starting any business outside India. Then here you have one method, that is CAPM method. Yes, that is also known as capital asset pricing model. Now, as per this particular model, we are going to calculate expected rate of return from the investment. Means what? See, for example, let's take one very simple example. I am investing 1 lakh rupees in, let's say, XYZ company. Yes. Now, after 1 year, I got, let's say, 1,20,000 rupees. Yes, this is the total amount that I received after 1 year. And here, if I ask you, can you tell me in percentage what is the return I have earned? What you will do? You will take the income, that is 20,000, divided by 1 lakh. So by investing 1 lakh, you have generated 20,000. So what is your return? That is 20%. So this is the actual return that you have generated. This is the actual one. So this, let's say you have generated in 2027. Yes, and you are investing in 2026. Now, if I'm asking you in 2026 only, what is your expectation? What is your expectation in case of return? Then let's say I am saying I want at least 17%. This is my expected return. This is my expected return, and this is the actual return that I have generated in 2027. But right now I am calculating for 2026, that what is my expected return. Now how to calculate this 17%? With the help of CAPM. With the help of CAPM. How to calculate this? With the help of CAPM. That is your capital asset pricing model. Now, for this CAPM, we require 3 factors. What we require? We require 3 factors. Factor 1, that is risk-free rate of return. Means what? Like if you invest in any government bonds, and as it is linked with the government, so is there any risk? No, there is no risk. And if there is no risk, return is also very minimum. Correct? Yes or no? Return is also very minimum. So that is the first factor we want. Then without taking any risk, what is the return you are generating? Then next is the beta. Beta means this tells you the relationship. This tells you the relationship between company and market. Yes, that is, if market goes up by 1, then your company goes by what number? If market goes down by 1, then how much your company will fall? So let's say, for example, if beta of company is equal to 2, it means if market goes by 1, company increases by 2. If market goes by 2, company decreases by 4. Double. है ना? This tells that company related to the market double of times. Yes, 2 times. That is what beta means. Now, third one means when you are investing in any share market. Yes, when you invest in share market, you need to bear risk also. Yes or no? You need to bear risk also. And here, when you are taking extra risk, you want some benefit. Yes, when you are taking risk, you want benefit. And this risk benefit is known as risk premium. This is known as risk premium. Okay, this is known as risk premium. So we require these 3 factors. Correct? This is the expected return that you want in your portfolio, and from that you will be getting the risk premium amount, then beta and risk-free rate of return. So let's see the quickly what is the formula that we need to apply. So here, calculation of CAPM, you required cost of equity. Yes, you required expected. This cost of equity is your expected return. Yes, this is your expected return. Equal to risk-free rate when you invest in a government bonds. Yes, that is your risk-free rate. Levered beta means this tells you the relationship between market and company. Yes, market risk premium means for taking extra, for taking, or let's say for taking risk, what benefit you want. Yes, that is what risk premium. So here RF is representing risk-free rate. This B is the symbol of beta and L is the levered beta. RM minus RF. Yes, so let's say, for example, if your company says that this ABC Private Limited says that if you invest in our company, we will give you 14% return. Yes, and if you purchase government bonds, so they are giving you, let's say, 9%. Okay, so what is the risk premium here? Risk premium means, see, without any risk, you are getting 9%. But as you are getting the risk, you are getting extra amount, that is 14%. Means here, 5% is your risk premium. For taking risk, your return is equal to 5%. Okay, this is what we need to calculate under CAPM. This is what we need to calculate under CAPM. I hope this point is clear. Now everyone, let's solve a question based on this. Okay. A stock has a beta of 1.5. Expected return of the market portfolio is 12% and the risk-free rate is 4%. Now, what is the expected return of the stock according to CAPM? Let's calculate our expected return. Yes, our expected return from this investment. So, let's first write the given details. So, we have beta, which is equal to 1.5. We have expected return of the market portfolio, that is your market return. Yes, this is your market return, that is equal to 12%. Then you have RF, that is risk free, 4%. Yes, we required only these three factors. Yes. Now let's use CAPM formula. So as per this, we are going to calculate required rate, expected rate, and that is denoted with RJ. So RF plus beta, RM minus RF. Yes. So here what is your risk-free data? That is equal to 4%. Right? 4 beta is equal to 1.5. Right? 1.5 for the beta. What is RM? RM means this is the market return that you are generating. This is what? This is the market return that you are generating. That is 12 minus 4. RF is your 4. So write 4 here. Correct? Chali. So now please use your calculator, and as per Bodmer's rule, first you need to solve the bracket. So 12 minus 4, this is equal to 8. 8 into 1.5 plus 4. So just multiply 1.5 into 8, you will get 12 plus 4 equal to 16. Let me calculate it again. Yes. So here 16% is your expected return. Okay? From this investment in the stock, how much I want the return? That is 16%. Yes, that is 16%. This is how we need to calculate for CAPM. And now let me tell you one very important thing, that this topic is very important and even asked in your previous year questions. Not only once or twice. No. In continuous attempts, they are asking question based on CAPM, and especially this numerical question. Yes, so if you know the formula, you can solve this in just 1 minute. Okay, chaliye. Now let's practice this equation again. So for that, we have one more question. So if the risk-free rate is 6%, expected return on the market is 14%, and the beta of a stock is 1.5. So what is the expected return of the stock using CAPM? Chaliye. So what are the given factors we have here? That is risk-free, which is equal to 6%. Then market premium. Yes, market return from the portfolio is equal to 14%. Then you have beta, which is equal to 1.5%. Yes. Now, what we need to calculate? We need to calculate required return, expected return. Yes. So, how to calculate it? RF plus beta, RM minus RF. Okay. Let's put the values in the given formula. 6 plus 1.5 into, that is going to be 14 minus 6. So here solve the bracket first. 14 minus 6 into 1.5 plus 6, and that is equal to 18%. And this is your answer. This is your expected return. Yes, let me tell you now one thing. Okay, now earlier I said na risk premium for taking a risk. So here this 14 minus 6, which gives you, that is 8. 14 minus 6, which gives you 8. This 8% is nothing but a risk premium. Okay, so in exam they can give you this market return. If they are giving you market return, so just subtract from this risk-free return and you will get the risk premium. Or they can give you directly risk premium. So if they give you directly risk premium, just multiply with the beta. Okay, no need to again subtract it from risk-free return. Yes, so these are the two formulas which you need to remember. Okay, I hope this point is clear to each and everyone now. Chaliye, we have one more topic. Let's quickly learn about APT theory. That is arbitrage pricing theory. This is also known as APT. Now this is again very important from exam point of view, and in your previous year questions also you can see this particular concept. Now see, CAPM, our previous topic, was about share market. When you are investing in the share market. But when you are practically investing, there are other factors also which will, affect your return. Yes, like inflation, GDP, stock indices, gold prices, risk free return. So there are n number of factors which will affect your expected return. Yes, which will affect your expected return. So as per this APT formula, they are saying why to take only the stock prices when you have other factors also. So as per APT formula, you are going to take all the other factors also in your calculation of expected return. Yes, chaliye, now how to calculate it? You require, of course, risk-free plus beta of each factor multiplied by the risk premium. Yes, let's solve a question here. The question is, following four factors have been identified as explaining a stock's return and its sensitivity to each factor and the risk premium associated with each of the given factors. First factor you have, that is GDP. So GDP beta is 0.6 and risk premium is 4%. Inflation rate beta is 0.8 and risk premium is 2%. Gold prices beta is minus 0.7 and risk premium is 5%. Sensex index return beta 1.3 and risk premium is 9%. And the risk-free rate is 3%. Okay, so how to solve it? You require expected return. First, take the RF. This is the RF. Okay, this is your GDP factor. This is your inflation rate. This is your gold prices. And this is your Sensex index. Plus beta into risk premium of GDP factor plus beta into risk premium of inflation rate plus beta into risk premium of gold prices plus beta into risk premium of Sensex index. Okay? Now, use all the given values, that is 3 plus beta is equal to 0.6 into 4% plus inflation rate 0.8 into 2%. Now here be very careful because you have minus 0.7 into 5%. Yes, then again add plus, that is 1.3 into 9%. Now let's see whether you can calculate this mathematical equation or not. Yes, now it's your turn. I have explained you how to calculate what is APT, what is CAPM, but what's the final answer? Now you need to calculate, and this is a homework question. If you are watching me live, you can tell the answer now also. Otherwise, you need to share your answer through comments. Yes, so this is about your risk premium. Chaliye, let's solve one more question. What is the primary objective of capital budgeting? Estimating the cash balance of a company? No. Evaluating the financial viability of a capital investment? Yes. Whether the investment will give you profit or losses, that is what we are checking. If it gives you the profit, accept it. If it gives you the losses, then reject it. So answer A, C and D are wrong here. Then the risk-free rate of return, RF is 5%, expected return on the portfolio, market is 12%, beta is 1.5. Now this is again your homework question. See, if you want to practice all these questions, you can download it directly from our virtual library. And for that, just use our Adda 24/7 app. Yes, you need to download Adda 24/7 app through Play Store, or if you are using iOS, then download it from that. Totally free app it is. Download this today's PDF and practice CAPM. Practice APT formula. Yes, because in your PYQs they have asked number of times about this particular equations. Yes, so this is about how you can download this PDF. And one more thing, if you haven't started your preparation for JAIIB December 26, then start with CIB Mahapart 3.0. where if you purchase it today, you need to pay only 7,999. And the best part is you are getting 6 plus 6 validity. But how you can avail these two things? By using one coupon code, that is Y895. If you use this coupon code, you will be getting maximum discount. Okay. And if you want to join my Telegram group, so here is the QR code. Just scan this with your mobile phone and you can become a part of my ABFM Telegram group. Now, apart from this, if you have any queries, any further discussions, feel free and ask me through the comments, or as I told you, you can join my Telegram group also. So with this, let's wind up this session. Thank you everyone for joining. Take care and bye-bye.